Hi guys, today I will be speaking about a topic which I personally consider the first and one of the most important pillars of personal finance, that's insurance. Today I'll be covering some insights over health insurance, and then the next one will be term insurance or life insurance in simple words. And I feel in a country like India, mm, to give you some perspective, uh, insurance is not a luxury but a necessity, right? With assumed medical inflation to be around 12%, mortality index, even though our lifespans have increased in the uptrend of things, but with new diseases coming, etc., with the glaciers melting, etc. I mean, I don't need to tell how pessimistic the news is, and see, wealth creation generation is not everyone's cup of tea. Not everyone has the aptitude or the destiny always to have that. But protecting your what you are having already, either when you're born with it or you've earned till now, a little or more doesn't matter. Whatever you have, protecting what you have, not losing that, and not getting worse is in your hand, right? We cannot avoid unfortunate circumstances in our life, but we can plan for it. I think that's what we call disaster management, recovery, etc. And so that's why I wanted to speak a bit about this. Now, generally, the main terminology which you need to search here are, sorry, there's already um, some things left. So, I mean, that was how it was, but so I will be basically giving you the main terminologies which are used when it comes to insurance. So first is the cover amount, right? Or the base sum assured, or base sum assured. What is it basically? It's basically, very simply put, if you are detected with any illness or disease, right? And in case of health insurance, critical or non-critical, whether it's your kidney failing, organ failing, or even in major injury or surgical hernia, it's the amount that you have. Ki, till then, whatever it is, we will take care of it. You don't need to spend your savings. You are safe, boss. Right. So that is what we call as cover amount. Then you have no claim bonus, which is basically, let's say in a year, you don't claim anything. Let's say nothing happened to you, safe and well, and you renew the policy. So you get no claim bonus. Generally, it's anywhere from 50% to 100% of the sum assured in different companies, and you get it up till a certain threshold point. Uh, so that is there. That's no claim bonus. It's good to deal with inflation, and I'll be explaining it with the Excel insights, which I'll be giving. So the next term is basically what we call PED. So pre-existing disease, or rather, it should actually be called pre-existing condition. Even gastric issue, as of that matter, comes under it. And generally, most insurance company have it 3 years. So let's say if you have even a related disease, which is somewhat relating to your PED, right? That's why I always tell people to declare it, right? What the worst case scenario is 5 to 10% there'll be an increase in insurance, but that would be it. So if you have a PED, any relating ailment to it or that itself, let's say if you have asthma, so something related to lungs, so let's say it's a disease directly affected due to asthma will not be covered for 3 years. Generally, it is 3 years in most insurance companies. In certain policies, it's lesser, and you can pay a rider and reduce it also. So till 3 years, whatever happens, that is not covered. And this is also called as so this is called PED waiting period, right? So that is there. The other one is something as called as um, special waiting period, right? So in that, or rather, it's called specific illness um, waiting period, like hernia, for example, you have. or you have certain knee surgeries, something that happens like that, or certain surgeries are covered after a certain period. So don't imagine that the moment you get insured, you are safe. That's why I say try to get insured as soon as possible so that when the duration happens, they cannot reject your claim. Just, so that I don't think immediately it will be covered. And then there is still, let's say, so what is covered in the first year then? If special illness is not covered, that surgery is not covered, pre-existing disease. So anything that happens out of injury, let's say you fell and you have an accident, and that is, anyway, you have accidental cover for that. That's a different story altogether. But that comes into picture. And then things like, let's say it's not pre-existing disease, but then you were hospitalized for something that is not pre-existing, right? It happened after the claim, etc. Maybe it's a stomach bug or something. Then that is also covered. Things even like bacterial infections, etc. are covered. With subject to some restrictions, you will have to ask your, either you can read it yourself in the policy document, or my suggestion is someone who's working in the industry, take their help. Right, so you have special illness or the specific illness waiting period, pre-existing disease waiting period, no claim bonus, cover amount, and riders, as I explained, riders are basically things which you take over and above. For example, you have things like consumables. So consumables are like um, consume are basically things which are basically things which are used in a surgery like gloves, surgical mask, etc. Which or even sometimes some plastic product, etc., which are generally not covered by the insurance. So for a major surgery like let's say a heart transplant, anything, it might be a 3-4% value. So let's say you want that also to be covered. Basically, in the situation of emergency, you don't want anyone who's your close one or you yourself to be paying bills there, sitting and paying bills. So there are certain policies which give you the option of buying these as extra riders. OPD, as you know, is OPD. You know, when you go for consult for a doctor, and um, in emergency terms, when you want treatment on the spot, that's generally comes under OPD. Um, and of course, you have many more terminology like pre-post hospitalization, right? Let's say MRI scan, diagnostic test, etc. They come under pre and post are generally, let's say, some follow-up or something happens, follow-up diagnostic test also. So those things you have to see whether a company covers it or not. Actually, that's not all. So I have only covered, you can say, I've touched upon the surface of the topic, which is why not everyone has the energy or the head to actually sit and understand it. So you can actually, of course, you will have to do your own research. Sadly, there is no other way around it. But what you can do is you can try tools like Ditto Insurance by Zerodha, or you can even try policy advisory like Policy Bazaar and get some insights into it. However, don't blindly accept anyone, whatever they say. Do your due diligence, but at least when talking to such advisories, you'll get an idea of certain things, and you'll get to and try to go. I mean, now you have ChatGPT, Google, YouTube. You have already so much information available to see that you've not missed anything. Okay, so that is all for now. I will also be taking you over some of the data which is there in India when it comes to health. So we are a population of about 1.4 billion, close to, and we do come under the lower middle class according to WHO insights. Um, as I told you at the beginning, there is a small decline at 65.8 now, and healthy life expectancy is actually, before itself it was 60, nothing to be proud about, but now it's 58, and honestly my assumption is it should go to 57, 56 when the actual diseases start, diabetes, BP. Well, BP is we all call blood pressure, which is basically hypertension, etc., that kicks in. So, and leading causes, of course, ischemic heart attack or uh, in simple words, basically heart attack either due to genetic, not due to genetic, but lifestyle disorders, or in general, heart attack is highest, as you can see, even chronic obstructive pulmonary disease, then stroke, either brain or heart, diarrheal diseases, with dysentery and all. They generally again causes more communicable, but then it again comes in this tuberculosis, which is bacterial in nature. Sometimes it's viral too, but then okay. Lower respiratory infection, again asthma related, and of course our diabetes mellitus, which is basically diabetes. Both type 1 and type 2, I'm assuming, are put here. And cirrhosis of liver happens due to alcoholism or hepatitis of forms. But some people are born with certain conditions, and then falls we will not know. And then, of course, preterm birth conditions are mostly related to women. But yeah. So, as you know, this is the WHO website, so it's not something that I'm, saying out. I mean, I have data to prove my points. So getting insured is important from this perspective. Now I will give you an Excel to give you an insight that how buying a health insurance policy actually gives you the hedge or the this. So let's say an ideal cover today is 10 lakhs. Okay, I'm not considering so over and above. My suggestion would be take a critical illness rider and have a term insurance on the side. Assuming this is done, normal day-to-day health issues, unless of course in this also I'm taking an assumption of non-CKD, which is chronic kidney disease, and I'm still taking certain assumptions here before giving this value because there's a lot that goes. But now, for now, I'm just taking it as 10 lakh, and I'm taking from the first year 10, and then I'm taking a 7% inflation, even though assumed rate is supposed to be 12. But assuming that government is intervening and trying to standardize the way, standardizing the rates all over, even the big hospitals, brands, etc. And if things go well, technology advances, medical care will not get cheap. Please let me clear, but at least will standardize and stagnate, and become more or less stagnant rather than, becoming extremely expensive. So this is why I've taken it as 7%, not 12. Anyways, I'll be attaching the Excel link, or you can ask me for the same. And this is basically derived from a hidden column, which is here, H column. You can just change the formula in that, and you'll find the value. You can adjust it to 12%. But now, for the sake of this video, we'll take it as 7%, shall we? So if we start with, and here for that I've taken, this is base cover is 15 lakh. For now I've taken Aditya Birla as the brand, and the policy is active on max. But any policy is fine, but you have to make sure the cover is appropriate and don't claim bonus and other things are lucrative for you. Right. So here it gives you a bonus of 5x, and it becomes the total amount becomes 90 lakhs. 5x plus, ooh, my battery is low. Nice. So it's 5x plus the 10 lakhs. So you get around 6x of total thing. I mean, the total coverage from the starting, and it takes about 6 years to reach this point. So basically, the inflation here, if you see the I column, it basically tells you if there is a deficit from the inflated amount of today and the cover amount. And till the age of 56, the answer is no. Right? Till 56, it's no, and here it becomes yes. I purposefully didn't write it because I wanted to write yes here. So that's how it works. So the first advantage which you get is till 56, assuming things go normal and all, you are actually insured up till the ideal cover amount, right? Of course, I've taken drastically optimistic approach, and I'm considering disease. I'm taking a very conservative number. But still, more or less till 56, that's a good number to be happy about. And many policies give you the option of increasing the cover amount, but my suggestion is try to plan it as soon because in insurance, as I said, the earlier you take it, the more benefit you get. That's thumb rule. That is a thumb rule. Will always be a thumb rule. right? So the max deficit which you can actually get is at the age of 63 for now, I've assumed, where your cover amount is 90 lakhs, but then the final value will become 1.5 crore or 15 million approximately if you want a foreign numeric system. So the deficit will be 60 lakh then. Okay. But till 56, if anything happens to you, if it's worth 10 lakh, the disease today, assuming a 7% inflation, should be covered. Right? Okay. Second, so this was the first advantage. Second advantage is what if I had put this money in an FD, right? An FD gives you a seven, and by the way, whatever amount you get from either health insurance or life insurance, the claim amount is always tax free because, of course, it's not income in its form. It's basically, again, I'll not get into the taxation of it, but just uh, sparing you the jargon, just assume it is not taxable, right? So it's tax free. This claim is. But if you had invested in an FD, that would have obviously be taxed. So I'm assuming 7% post-tax return, which, as you know, how much would it need pre-tax? That means close to 10% has to be the FD interest rate. And how difficult that is to get in a TEP or a guaranteed return is known to everyone. But let's say you're somehow able to generate it easily. I've taken that, and this basically this formula is to for the tenure. So it starts from 41 minus 40 years, and then the second one, the second value is basically this plus this, which is uh, the new calculated in which the duration is reduced to 39 years. 2 minus 31. So that's how it goes. And like this, it's increased. And the final value which you get, right, 27 lakh 54 is basically the value that all these yearly, these premium, by the way, E column, I'm sorry, I didn't tell this before, is basically the premium you paid for the 15 lakh cover, right? This is the premium paid, an actual total premium paid. And I think the total premium you pay in close to 41 years is 7.6 lakh. An average being around 18,607, which if you see monthly is around 1,500 rupees, close to, right? So again, that itself says a lot. I mean, I don't need to spoon feed every info. I think you're getting the picture what I'm trying to tell you. And if you see 27 lakh here, the total amount, uh, that's when I have assumed 7% post-tax return in an FD for the same amount of premiums I'm paying yearly, depending on the tenure, decreasing tenure. So this is the value that it becomes at the end, right? And let's say, unfortunately, God forbid, something happens at the age of 63, and I require this amount, right? If I have this cover, I'll still be deficit by 60 lakh. But if I use this, I will be deficit by an amount greater than 1 CR. Of course, the value of 1 CR after 40 years will not be a lot, but that's a discussion, inflation and future values, a video for another time. Let's get into the economics of that later. I'll not say finance, but economics for that. But if you want to see how much actual, the cover is to the um, net saving ratio, if you see, is 3.27 times. I'm sorry, the rupee is coming because of the formatting, but it's 3.27 times benefit you are getting here in the if you wait till the policy. Similarly, for 20 years, I have taken the tenure only from 21 minus 1. So it's like that, 20 years. If I want to keep it invested and I have used the same, so it becomes 4 lakh 62, right? And then same thing for 10 years. The same the funda of calculation remains the same, only the numbers change and the duration changes. The interest rate is also taken the same. So here I want to see the ratio. The ratio becomes this divided by this, a whooping 19.45. So if anything happens to me after 20 years, when I'll be 43, right? 43. I just wanted to select that row. Anything happens to me at that time near that time, which is very susceptible to most of I mean, I told you, the healthy age is 58, and I'm saying very good chances it might reduce, even if you take it as 55, right? The right now the ratio is 19. This ratio still would be more than 10, I feel, or at least more than 5, 6. So you're still getting an advantage. So any disease that happens, what money you would have saved in a debt fund or an FD, definitely the insurance or cover covers it, right? And let's say uh, the returns up till 10 years, FD, sorry, returns in FD, if it's 10 years, then let us just for fun's sake, when let's say 33, of course that's improbable, but for the sake of it, let's just take it. It will be around 69 times. So that's the point. Of course, it's simple, I mean, relationship mathematics, but then just wanted to tell you that even if you wait till the end of the policy, there's still a benefit. But let's say now one might debate, what if we get an equity? Of course, equity is taxed even long term at a point, I mean, 12.5%. But then I'm assuming a 12% post-tax rate in the long-term schemes and your amount. So then if by the same funda we go, right? Of course, I've not done the whole tax efficiently calculated, but then I'm giving you a number. So I just calculated it, hidden it, and just copied it. The value would become 94 lakh, which is still almost the same as the cover amount, which means putting the same amounts, premium amounts yearly in Nifty 50 fund, and how much Nifty 50 has given us? Let us see. 15.1, which effectively would become around after tax long term would become 14, right? 14, or rather 13.5 something as post-tax return. So I've taken it as 12 to be on the safer side, the safe large cap equity of the Nifty 50. So that's around 12% post-tax I've taken it, 13 point something as pre-tax. So if that also figure we go with, we will have the same amount as cover. So I'm taking it as 1 is to 1 ratio. And the same thing if we do for 20 years. And here I've taken 12.5. So I've not printed the calculation in, I just pasted the value, but this here I've taken it as 12.5. Still, so the ratio here is nearly 1. So we will not give the sign for this, it's nearly 1, approximately 1, right? Approximately. Here, on the other hand, this divided by this. Even then, even in the 20-year one will give you a 10.42 return. And here I've taken it as 13%. I'm assuming the next 10 years, it as 13.2, I think I've taken it. So almost as good as the Nifty 50, which is performing, which has been this basically I got from Google, right? So this 15.1 number, it's basically if you Google searches Nifty 50, the past 20 years is given a CAGR of 15.1, and the last 10 years it's actually given lesser, but I'm taking it as more, assuming best performing, etc. Then also, I want you to see the ratio. I mean, I don't need to, do this for you. You can just, you don't even need to. You can orally just do it. It's hard, not even 2 lakh. It's 45 times you're getting the benefit. If anything happens to you after 10 years. Let's assume that till the end of this policy, I mean, you can also take it till 70 also, but um, I mean, you have to see which policy you're taking. I mean, document, max, min, capping, all that has to be seen, and you have to have an advisor for that. I'm not a financial advisor. I more just give into the insights to people that, maybe I give you can say the path to how to think about finance. But if you do think about it, till 63, which is a good age of estimate for most people of sedentary lifestyle and sitting health issues, etc., if they live, you have paid a premium of only 18,607. Even if I add it till 64, 65, till that, what I'm assuming the average would be, it might even shift to 19,000 and divide that by 12. So It'll be 1,583 rupees per month. Now I know because what I'll do is I will get here and check the price of a pizza. I don't want to take names because then there might be a trademark issue, but I'll just see the price of pizza, a large size pizza, of the major brands like Domino's and Pizza Hut, and also the average. Okay, it's been some time since I've ordered pizza. I really do crave for it though. So let's go with veg pizza. Let's go for a Mexican bean dip. And then if you see, even the large size pizzas, if you have twice, or let's say if you go out to a pub a month, this is the cost per person. So that's basically the insight I want to give. So even if you never have to make a claim till 65, and let's say something bad happens at 66, right? The worst you are losing is 1583 rupees, which is equal to going to a pub, and that's averaged out over 40 years. That is what I wanted you to understand. I mean, I know I dragged the point, but this is also to give you insights. And this is just one about one brand. I mean, every brand has their own advantage. HDFC has some beautiful pointers, but then the price is slightly steep. Then the customer support and everything, as even if you've what my friends said, no, it's quite par. It's quite good. So yeah.